you have to make sure that once you have told people you have to pay in the future, you actually do implement the payments. Otherwise, people won't believe you the next time you try to do the same thing. And so it has to be, if you don't pay, you have to have negative consequences. Okay, but in this case, it's fine, prisons, or death. Okay. And of course, the government that do not or cannot enforce the dues will see their monetary sovereignty challenged, and that creates problem to move resources for the public purpose. Okay. So what are things that could challenge this monetary sovereignty? So if we don't trust that the government will have the ability or willingness to enforce the tax payments, okay, well, then that creates problem to create an acceptance for the currency. If you have poor enforcement mechanisms because tax evasion is widespread, you have corruption of tax officials, that also weakens the acceptance of your currency. If you have a large informal sector, also a lot of people can operate outside without the needs to basically get involved with government. And so in that case, the domestic acceptance of the domestic currency may be limited. Okay? And so domestic government may have problem to create acceptance even within the domestic economy. Okay. On the other side, you have some governments today in the United States that have political and economic power that extends far beyond the national boundaries, and with that, you expand the ability to create a demand for your currency and to extract resources outside even your domestic economy. Okay. So with that in mind, we try to operationalize the index by answering 4 questions. So here is the first set of questions, okay, which is first, are your resource suppliers unable or unwilling to sell to the government goods and services priced in the domestic unit of account? So here you have a yes or a no. And the second question is, can the government run out of money? So yes or no. And combining the two, you get these 4 possible answers. So if you don't have any resource constraints, and if you don't have any financial constraints, then we are on the left block here. Is there a laser point? Yeah, we're here. And on the other side, if the opposite case is where you have no suppliers that are willing to or able to supply, and you can run out, you have a financial and real constraints, and then you have these 2 cases. And so where I come here for the index is that we try to operationalize number 2. Okay, can you run out of money? That's going to be one part of the index, and another part is part of question 1, which is the willingness to accept the currency. So the index is not concerned with what I have not found a better word for that, with hard real constraint, the fact that you are unable to supply. It's more concerned with the willingness to supply. Okay, so can you create acceptance for your domestic currency? Okay, so that's the first set of questions. The second set of questions is regarding the financial praxis and the policy-making praxis of governments. So first one is, how do policymakers judge a policy proposal? So one is a sound finance pay-go metrics. The other one is a functional finance resource metrics. And the second question is, do the Treasury and Central Bank work together? Okay, and so they can coordinate their decisions or not. Okay, so if you have a coordinated government that works on sound finance metrics, this is what most governments do today. Okay, MMT wants to move to more the policy-making praxis mostly. It's not concerned with changing the financial praxis. Okay. The other side is if you have no coordination, so used to be the Eurozone, now the Eurozone is moving away from no coordination, but a currency board would be another case. And we have the last case, which I don't know example of, I cannot come up with, which we have functional finance resource metrics and no coordination. I don't know any example of that. And so what we want to do is, again, in the index, we're not going to be concerned with policy making praxis, which is the core of what a lot of MMT wants to talk about. We are really concerned with question 4 here. Try to find a way to operationalize how we measure this coordination. Okay. So going through these questions, here are some of the things that I have thought about. So regarding part of question 1, the willingness to accept the domestic currency, I guess here you have several things you can look at. So the size of tax evasion, the more of it there is, the less monetary sovereignty you're going to have. The size of the informal sector will also matter. Okay, because again, if people can operate outside the domestic economy, well, they have less chance to. They don't have to necessarily work for the government. They don't have to declare anything to the government. And so with that, of course, we know we have countries in which the dollar is used in the private domestic economy mostly, and you use only the domestic currency to transact with the government. Okay, so that lowers your sovereignty. So the size of the use of non-domestic currency in private transaction is there, and a capital control will be another one. Okay, that I will put there. Okay, do you allow people to use easily other currencies or not? Okay. Regarding question 2, the way I would operationalize this is: do you issue your own currency? Okay. Is if you do you have a convertibility or not? If you don't, then you have more sovereignty. Do you use a material that is easy to provision to make physical monetary instrument? The idea here behind is, well, if you are using gold, that's much harder to provision than if you use paper, or even easier, just electronic entries. Okay. So that can influence your monetary sovereignty too. What's the proportion of foreign currency denominated debt that you have? Okay. So the more of that you have, the less sovereignty you have, okay, because you have to be concerned with earning the non-domestic currency. Okay. And then at the same time, if the size of your foreign reserve is large enough, that can offset the problem you have with the previous point. Okay, and so there you have a counterbalancing effect that you want to take into account too. Okay. So that's for question 2. Question 4, the operationalization here comes by looking at, first, can the central bank participate in treasury auctions? And here there is a variety of ways through which this happens. It can be direct buying, unlimited buying of treasuries. It can be constrained. For example, in the United States today, the active direct involvement of the Fed is limited to replacing maturing treasuries on its balance sheet. Okay, but if you go to Canada, there is no limit. Okay, you can buy directly at auction whatever amount you want. Okay, and you go to other countries, you're going to have a variety of different institutional setup regarding how the central bank can participate. If the central bank is limited in its direct participation, is it possible for it to be indirectly involved? Okay, which is basically today what we have in the United States or in England, okay, where the central bank finances the key participants in the auction. Okay, so the primary dealers in the United States, the gilt hedge market makers in England have a direct financing line with the central bank. So at the time of the auction, if these institutions don't have enough funding to buy the treasury they bid for, the central bank will provide them the financing they need. Okay, so you basically have an indirect central bank involvement in the auctions. Another one is, does the treasury have any monetary power that it can use on its own? Okay, that are there available to it? Does a treasury issues or redeem securities for non-budgetary reasons? Okay, that's another important element to look at. We know that in monetarily sovereign countries, the public net is not managed merely for budgetary purposes, meaning that they will issue. So how do you look at that? One way you can look at that is if when the treasury is running a surplus, that it still issue public debt. Again, we have cases of that. It's where you have a non-budgetary use of those of the public debt. Does it issue public debt at the request of the central bank, okay, for monetary policy purposes? Or does it issue public debt at a higher interest rate than it could, and why? So again, we have cases of that with yield curve control. We have basically the public debt become endogenous because you have to respond to the need of the market to make sure that you fix the prices. Okay, so if you fix prices, you lose control of quantities. Okay, so that's another way through which you lose control of issuance and redemption of treasury securities. Also, the last one is, how does the treasury manage its inflows of taxes, and does it manage it in a way that is not necessarily logical with budgetary needs? So again, to take the case of the United States, for which I'm the most familiar, in the past, when the US government used to receive tax payments, we know that they flew into private bank accounts, okay? And to be able to spend, they had to move these funds into their account at the central bank. But at times, even though they had plenty of money that could move from these private accounts to the central bank account, they would not do it for monetary policy reasons. And so instead of using the tax revenue they had, they instead asked the central bank to provide them a credit line to be able to spend. Okay, so here you are, a clear case of managing your tax revenue for non-budgetary reasons. Okay, so those would be things you would look at for question 4. Now, regarding the index construction, here the simplest and the really rough one would be just a dummy variable, okay, with yes or no, okay. But I have done work on indexes in the past for financial fragility, and that's where I would like to go to with this more complex and probably more rewarding version, because there you are able to have a time series, and also if you can find common sets of variables, you can also compare countries. That gets actually difficult to do, at least for the financial fragility index. You have a continuous index bounded between 0 and 1. Okay, there we could add weights. We'd have to think about how to do that. Again, there are several ways to do weighing. You could do it thinking of more theoretical way. You think this is more important. You can do it through principal component analysis to try to weigh different things, or other methods you can think of to try to think of weight if you want to put weights. Again, that's the thing. think about. And once you have that, then it's a matter of your index is a function of these different indicators we looked at in the different questions. Okay. How are they? Another issue. It's like, okay, issue is that you have a linear relation here or a non-linear relation. So you have all kinds of things to look at in terms of how you do the index. So it's more technical. So the use of the index, of course, one is an econometric analysis. Okay, and the question is, do you get any explanatory power from that variable? We know Tymoigne and others have worked a lot on that, which is the idea that the central bank is a key determinant of the interest rate on treasuries. And we know it's a very strong coefficient. And the question is, by adding this, first of all, is there a bias in that estimation by not including the monetary sovereignty index? And can you over capture the effects here? And so introducing that index, does it do anything? And I don't have an answer to that, so I can't tell you now. But the expectation is that yes, it does. Okay, and that given everything else, the more monetary sovereignty you have, the lower your interest rates are going to be given everything else. Sam came with over here, and I worked on a paper under submission now for that tries to look at a panel time series analysis of different monetary regimes through times and try to estimate this equation here that basically is pretty standard, where you look at interest rate on the public debt, long-term ones, and see how they are linked to short-term treasuries, which is monetary policy, inflation, and fiscal balance, of course, is of interest to us. The idea is that the fiscal balance constant should be, or parameter should be pretty weak. Whereas the beta one, which relates to monetary policy, should be pretty strong. But what we would like to add here is, again, an index of monetary sovereignty to try to see if we have some explanatory power at all there. Then, of course, as I said at the beginning, you want to raise awareness of constraints that exist in policy making, and policymakers lack numbers. So if you can give them a numbers of, this is your degree of monetary sovereignty, so that's one piece of information you can use. It also puts them put that on their radar, okay, as a discussion among the public on what are the constraints within which you are operating. And for the theoretical aspect, it's, well, making academics aware of the relevance of monetary sovereignty. Again, there's a tendency to lag numbers, okay, and so if you can operationalize this concept, you probably will gain more attraction in making people aware of the importance of that concept. So, thank you.
Okay, normalizing monetization. Kind of thought about this topic because over the last several years, the idea that MMT is the same thing as monetization became sort of the definition of MMT by everybody who isn't MMT, which it seems weird to me because it kind of seems like the way the neoclassicals are to Keynes, where Keynes is sort of, the innovation he had apparently was a fixed wage model, which if that's all he was going to do, he didn't need a 400-page book, right? They kind of already understood that by then. Same thing with monetization. So we didn't need to name it MMT. We already had a word, monetization, right? So obviously that's not necessarily what we're saying. So what are we saying? This is what I'm not saying. Monetization through government central bank cooperation should be how government deficits are financed as a general rule. This is the sort of doing MMT that people incorrectly assume is what we're talking about. What I'm saying is whether deficits are accompanied by bond sales or monetization, for the most part, is not important if we understand what monetization is versus what it isn't. So if we normalize monetization, what I'm referring to is recognizing that it is normal in the sense that it already happens all the time and without the consequences we were told to fear. So if we accurately incorporate it into models and theories, we should then end up mostly indifferent to how deficits are financed in the real world. Do economists understand monetization? You might already know where I'm going to go here. So in the real world, and Randy went through this in his 1998 book, so it's, but we're still here trying to explain this. The impossibility of monetization without sterilization. So I'm broadening a definition of sterilization here because we weren't talking about a floor system prior to 2008 for the most part. But with the floor system, the sterilization comes by paying interest on reserves at the target rate. Whereas if you are running a corridor system or any system where the interest rate target is above interest on reserves, in order to continue to achieve that interest rate target, you are going to have to drain the reserves when you run a deficit. There's one economist that understands it, Coach Lakota, where he says there's absolutely no economic difference between the two forms of financing. Right. In the first case, Treasury pays interest. In the second case, the Fed pays exactly the same interest. The crucial point is there's no need to employ helicopter money because it's not really a thing. It's just one entity, one government agency running the deficit or issuing the liabilities and paying the interest instead of a different one issuing the liabilities and paying the interest. So this is going to be quick here, but there's a point to it. And you guys have surely seen this by now, but when the government runs a deficit that creates a surplus in the private sector, of course, when they do that, they do it by crediting bank account reserves, and the banks then credit the recipient's deposits. Whether you issue bonds afterwards has no effect on the fact that you created net worth for the private sector. That is the thing that matters, not the financing. I'm going to come back to that one a bit later. And if the government isn't the one that issues the liabilities, somebody else will have to do that because that is operationally necessary to achieve the central bank's interest rate target. Again, this was all in Randy's book in 1998. Okay, so let's go to the way that we hear it from the neoclassical side, which they actually get to the correct conclusions, but they do it incorrectly or for the wrong reasons, we'll say it that way. So they tend to look at it two different ways here. Like I say, view A, view B, where you are either, they got it correct that you're shifting the supply curve on reserve balances to the right. But in view A, you've raised the interest rate target up, or interest on reserves to be equivalent to the interest rate target. And that will stop money in its tracks, printing money in its tracks, or you've allowed the interest rate to fall to zero. And you're running a zero interest rate policy, and that will also stop printing money in its tracks because the interest on so-called money is the same as the interest on bills. And so instead of printing money, you're actually printing bills. And that's the case, and that's what's going on in both cases from their perspective. People need to quit doing that. Anyway, the point here, though, is from their own perspective, these two things stop the effects of money printing from being more than the effects of running a deficit and issuing bonds. But those are the only two ways operationally you can print money when you run a deficit. So hopefully you're kind of squaring the circle on that one in your own mind, right? And, you know, we don't need any more proof of this than Paul Krugman, who's always right and never changes his mind, where he says, right? He's got his lower bound, his liquidity trap. It's Krugman's liquidity trap because it has nothing to do with Keynes' liquidity trap. On the left, I've got a quote from the New York, some researchers at the New York Fed, who also seemed to think that there was a money multiplier if we didn't pay interest on reserves, which is sad. But so there you go. See Krugman recognizing both of those stop printing money in its tracks. So I had a little debate, I guess you'd call it, with Simon Wren-Lewis a few years ago on Twitter, where he says, if interest rates are zero, you can create as much money as you like with no effect, right? The zero interest rate policy, view A. But at positive interest rates, there has to be a relationship between high-powered money and interest rates. And I said, well, no, Fed's doing that right now. And he says, but you can't determine both quantity and price. Of course, guess he hadn't heard of a floor system by 2018, which is kind of interesting itself. But so I just reminded him of the floor system. So then he says, in that case, with reserves included in definition of money, the simple liquidity preference story does not work. But does that matter, as reserves are now costly for the consolidated government? First off, notice that he said consolidated government, right? And I waited around for a few days just to see all of the MMT haters come in and hammer him for using the term consolidated government, but they never did because they only like it when we use it. Or they only don't like it when we use it. So as I pointed out, right, those are the only two ways you can print money. In the new Keynesian model, those are both cases of liquidity preference doesn't work. So bonds versus money doesn't matter even in their own model for the wrong reasons, but it doesn't matter nonetheless. But still, they think that there's some sort of money printing thing going on here beyond those, which is really awkward and odd. And so we go to Galli's paper that's quite popular in the neoclassical monetary theory, came out a few years ago. And so we find the answer there. When the zero lower bound is not binding a money, so he's saying you are running a corridor system, okay, not a floor system. A money finance fiscal stimulus is shown to have much larger multipliers than a debt finance fiscal stimulus. So we're still back to the point of what on earth do they think is happening? Unless they're violating the laws of supply and demand. I mean, think about it, right? You've got supply and demand. Just think of the graph in your head and you shift the supply curve way off the entire graph, right? What happened? Price fell to zero, right? The only way you can keep it from falling to zero is if you put a floor in, right? But they're saying we don't have a floor, but we shifted the supply curve all the way to the right and we still have the price above zero. How did you do that? I don't know. We get a little bit of an answer from, I always go back to this from 2011 from Scott Sumner, where he explains how he says that we aren't going to get anywhere if we keep talking about interest rates and reserve requirements and bank reserves. I'm talking about changing the monetary base. I'm talking about doing so in normal times when rates are above zero. So let's ignore the banking system and assume the Fed buys 100 billion in T-bonds from the private non-bank sector. They pay for the bonds with currency. Well, there you have it, right? You get there if you assume a world with no banks. That's how it works. So just as we assumed, or just as we thought, they were analyzing a world that doesn't actually exist. So, okay, do you know the middleman? Popular myth is that this is how deficits happen. Private savers lend money, purchase bonds from the US government, or whatever government, and the government spends. That adds reserves to domestic banks, and they add deposits to their recipients' accounts. At the margin, in reality, what's happening, though, is that the central bank in a liquid market is lending to the dealers that are at the margin buying the government bonds. And so this is the thing. If you're talking about a liquid market, you have to bring credit in because that's what is happening in the first place. You've got credit creation in a liquid market because you are affecting the price in terms of market liquidity, in the sense that whoever comes, however much trading goes on, market liquidity is defined as somebody can go in and sell a whole bunch of bonds and that doesn't move the price away from some fundamental or some arbitrage condition. That only happens in the real world if you're involving credit. And if you're involving credit, then for it to continue, you got to have a backstop. Well, if we're talking about treasuries, we're talking about the backstop being the central bank, because the treasuries are at the top of the hierarchy of liquidity. And a little more on that later. So if you're thinking about, well, who's going to buy the government bonds, and you're assuming a liquid market, you're already wrong, unless you put credit in there, endogenous credit creation. Okay. Well, we can see this if we think about the taper tantrum about 10 years ago, where the Fed talked about slowing down its quantitative easing purchases. Didn't slow them down, but talked about it. And we can see that the short-term interest rates there didn't move. The long-term interest rates increased, right? Intermediate and long-term interest rates started to increase. So the taper tantrum shows which of these is true. How's that? Well, these two things cannot simultaneously be true. Quantitative easing shifts the supply of loanable funds, or if you want to talk about the demand for bonds, either one, it's going to have the same effect, which reduces the interest rate on government bonds. Can't have that happen and also have a taper tantrum. Those two are internally inconsistent, logically inconsistent. You can't have both of those happen. Why not? Because a taper tantrum means the interest on government bonds rises despite the quantitative easing operations. Fed didn't slow down its quantitative easing, but the interest rate increased. So how was quantitative easing reducing interest rates? Well, it probably wasn't beyond what the markets were expecting the Fed's target rate to do. So in other words, available market and funding liquidity was far greater than quantitative easing operations. And the minute that the markets expected higher interest rates in the future, they kicked in and raised interest rates. So what we really have is a hierarchy of liquidity there, where treasuries are among the markets at the top of the hierarchy of liquidity, and they are backstopped by banks, and they are backstopped by central banks. The banks themselves are backstopped by the fact that central banks set an interest rate target. Again, you got to bring in endogenous credit money creation to understand that. Okay, so the reality is printing money just cuts out the middleman rather than adding jet fuel to the deficit. So standard practice is on the left. This is what we do in normal times. Government runs a deficit at the margin. The primary dealers are being financed by banks, and then if they need to, by the central bank. On the right is printing money. You just cut out the middleman. That's all you did. If we monetize and no one hears it. So Philippines, during March through April 2020, they did a 300 billion, sorry, their central bank did a $300 billion Philippine peso repurchase agreement with the Bureau of the Treasury. Nobody batted an eye. A little bit later, they paid an advanced dividend to the Treasury. These were both just printing money, right? They just credited the government's account. The government spent. Later on, the government might issue bonds to create the credit in its own account to pay it back. But it was a case of spending first, issuing bonds later, for sure. United Arab Emirates and Saudi, this goes for Saudi Arabia and others like that. When they sell oil and receive dollars in exchange, I got a simplified version of what was on the other slide here. On the left, they receive US dollars. On the right, they credit the government's account, but it's in a different currency, right? And the government spends, which adds to bank reserves. That's what's going on the right. What I don't have there on the left is what does the central bank do next with those dollars? They invest them in US treasuries. They send them to their sovereign wealth fund and invest them in equities and such. It's just crediting the government's account and sending the money somewhere else. Singapore Singapore says, well, we don't issue bonds the normal way everybody thinks of issuing bonds because they're unrelated to our fiscal needs because we never run deficits in Singapore. Right? And Singapore is, most people would think of, you wouldn't think of Singapore if you thought about a government that is threatening its credit rating, let's say. You wouldn't equate them with Greece or anything like that. Okay, so we issue securities to develop a domestic market. We issue securities so people have savings, et cetera, not to finance government. Well, the reason why they do that is because they're printing money like crazy. And they do it under the guise of the net investment returns contribution from the national reserves, which they never tell anybody how big the national reserves are. Okay, they have two sources. They can take up to 50% of those sources of net investment income and net investment returns. I'm going to start with net investment income. So net investment income is basically like what I just showed you with the United Arab Emirates. Foreign currency and interest and dividends, etc., comes back to the central bank. Central bank credits the government's account in the domestic currency. They spend. The central bank, could be some combination of the government and central bank, issue bonds to drain the balances, and they reinvest the dollars. Right? There's an even better one though. Well, first off, and then the central bank reduces remittances, so it's the government that ends up effectively paying the interest on those bills. Okay, that was T accounts. I'm going to skip the T accounts. Net investment returns. This one's even better because there's no cash flow at all. They just say expected real long-term capital gains of the National Reserve. So they say, well, we think over the long term we're going to earn 10%. Oh, okay. Well, let's put half of that in the government's account. That's literally what's going on here. So they credit the government's account. They spend, they issue bills to drain it, reduce remittances. That's it. Okay. So this is exactly the same as the one by United Arab Emirates and their net investment returns, except there's no actual cash flow here arriving. They just say, well, the returns will be in the future this much, so we'll credit the government's account this much. Right? So printing money happens all the time in the real world. Economists don't understand accounting operations well enough to know this. This also means they don't understand that printing money isn't its own thing. It's just a different, as I said before, government agency issuing debt at the central bank's target rate or roughly equal to it. Maybe good economists don't know this because they freak out. But it happens all the time and it's not inflationary on its own. Maybe we should reconsider our theories, just saying. What if we mint the coin? What does that one look like? Right? Oh, it's supposed to be massively inflationary, right? Well, US mints $1 trillion coin, credit treasury's account, government spending, Fed sells bonds, pays interest on reserves in the floor system, reduce remittances. Looks a lot like what Singapore's doing. Anybody think anybody criticizing Singapore? Right? It's actually less inflationary than Singapore because Singapore does it in order to spend more. Mint the coin is not about spending more. It's about getting around the debt ceiling so you can spend what you already passed in the budget. Okay, who really wants market discipline? This is from Indonesia's central bank law. And I want to focus on that third point right there. Sorry, is it the third or the third? So they're basically talking about what to do with the central bank's profits and how they're going to be sent back to the government. And in number 3, they say, well, in the event that after measures referred to in paragraphs 1, etc., the capital or equity of the central bank Indonesia is less than 2 trillion rupees, which, I don't know, 15,000 to the dollar, I'm not sure. Last I checked. Anyway, government shall be required to cover the deficit after approval from the House of Representatives. And most countries, if not all of them that I've looked at, do the same thing, right? That if the central bank's equity gets below 0, they'll be recapitalized by the government. Well, why would the central bank want the government to be subjected to market discipline then? Would you want your backstop to fail? Probably not, right? And when I presented this in Indonesia, and there were some policymakers from the central bank there, so I made sure I put in big letters what was going on. Anyway, okay. So, and lots of people have said this next one, I just knew that I had said it, so I put it here, is clear enough. Another reason why the central bank wouldn't want market discipline applied to government debt markets is because the yield curve for the risk-free rate is a benchmark to use for the pricing of other assets, meaning it is part of the transmission of monetary policy into the economy. It's also part of stability of the financial system. So there's two primary reasons then for a central bank to support government liabilities. Reduce the yield curve below market expectations if the market expectations aren't low enough. This is what was attempted with QE, it's probably successful with yield curve control. Or to support market functioning where liquidity is insufficient. That's probably what the Philippines was doing. Okay. Oh, forgot I had the Philippines slide about where they entered the market. I talked about the money printing, et cetera, before, but they entered the market a couple of times to create more liquidity because they didn't have a liquid market. And then they received Asian Development Bank loan to improve liquidity in their financial markets. So China, a former member, I can't say these names, so I'm not going to try. But former member of the Central Bank Policy Committee. Currently, Chinese government bond market has plenty of room for government bonds. If there's a problem with market liquidity, central bank will buy and sell government bonds in the secondary market to provide liquidity. Biggest advantage is that it can form the yield curve of government bonds, provide a risk pricing benchmark. Right? So basically said both of the points. Right? Why would we do it? Well, if the yield curve's not low enough and we want it lower, or if the market's not functioning because it doesn't have enough liquidity. They were getting pressured to do monetization, and they were saying, we don't need to do monetization because the two reasons we do monetization aren't a problem right now. In reality, there are only two choices. We were talking, there was some discussion this morning about what's going on with US Treasury markets and some problems that have arisen. There are only two choices. You can have the central bank run the government debt markets itself, issue reserve balances or its own liabilities, equal to at the very minimum any bonds the government wouldn't sell at the central bank's desired interest rate. That enlarges the central bank's balance sheet permanently by similar to the size of the national debt. Or you can continue the traditional illusion that there's such a thing as price discovery in government bond markets, while the central bank still implicitly backstops these markets at all times, in addition to any repurchase or open market operations in government debt set to the interest rate target. This is the pre-Basel III world. This is before we started to get some of these newer regulations, where there was never really a crisis in a liquid government debt market. It was everywhere else when it went into crisis, it went into the government bond market. And that was the safe asset. But now we are having crises in government bond markets. So what's going on is they're attempting a third choice, and the outcome's pretty predictable. So due to these new liquidity and capital requirements, banks are limited in how much they can support government debt markets, including funding liquidity to dealers. So attempts by central banks to normalize balance sheets to pre-COVID, pre-global financial crisis sizes exacerbates this. They push greater responsibility for dealer funding and liquidity onto banks. So at the first sign of any disruption, funding liquidity from banks into repurchase markets for dealers dries up. Central banker intervenes quickly with market functioning operations, takes a large part of both markets onto its balance sheet. When the crisis ends, central bank tries to normalize its balance sheet. People start to view these market functioning operations as support to government, rinse and repeat. So the result is we have regulations say don't buy government debt. So when the crisis comes, everyone wonders why banks don't buy government debt. So the central bank has to step in again because financial stability and interest monetary transmission. In the interest of time, I'm going to speed up there. Can we push this still further? Imagine if government spending occurred through loans by the central bank to recipients, and then the central bank canceled the loans. We'd only have reserve balances created that earned interest on reserves. Reduction in remittances would leave governments effectively paying the debt service, but you wouldn't issue any government bonds. Would you worry about the national debt? Where would it be? Whose is it? Go a step further. Recognize that bank solvency is something that's regulatory or legally determined. There's no sure thing as an insolvent bank. What if the government spending occurred through banks crediting customer deposits? Then regulators let them record this as a negative liability rather than a decline in equity. Might have to subsidize because the banks would have some additional interest they'd have to pay on their liabilities because they'd have to fund the outflows when people spent from those accounts. But it'd be kind of like a smaller number than current debt service. Would you worry about the national debt? Where would it be? Okay, conclusion. Let's remember again why we have deficits in the first place. Oh, I thought somebody was writing up there. Okay. Jason Furman, one of my favorites. Our fiscal goal should be a gently declining, he says that like, gently declining debt to GDP ratio. Requires deficit average about 3% of GDP over the cycle. It should be better than that when growth is strong, blah, blah, blah. What are the implications for the path of the private sector's balance sheet, financial balance? If you do that, while following whatever you think is the most likely path for the current account. Of course, I'm asking him about the private sector financial position. And shockingly, there was no response. So maybe because I thought I was nobody, but you might be right. But anyway, okay. But normalizing monetization and monetary theory, even in their own models, deficits with monetization isn't more inflationary than a deficit with bond sales. A liquid market for government debt means the central bank intervenes implicitly or explicitly, whether you don't need monetization for that. You've got the central bank already creating endogenous credit. So monetization already happens all the time. Central bank has no interest in disciplining government in its own currency. If we understand all of this, we can think of monetization as just another standard normal choice along with bond sales and even more creative alternatives. And that's a better approach to monetary theory. And that's the more along the lines of what MMT means when in general, rather than saying MMT equals monetization. All right, that would be closer to doing MMT. Okay, that's it. Thank you.
Hi, everyone. I don't have any slides. I'm returning to form of just talking. It's funny. My talk is very related to what we've been talking about, but nonetheless, both Eric and Scott's talks have kind of stirred up all the things that I've been thinking about in terms of research in my book. And so I almost feel like giving a completely different talk about the research I'm in the midst of. But I'm gonna restrain that instinct. Instead, I'm talking about essentially something that I wrote about over the summer in my newsletter, Notes on the Crises, for those who don't know. And it's specifically focused on this question of rating agencies. If you've been around kind of alternative macro ideas, MMT, regardless, the rating agencies are a typical villain, whether it's getting things wrong during the great financial crisis disastrously and facilitating an epidemic of mortgage fraud, or it's simply their pronouncements on governments. And I've been interested in the last couple of years in both how rating agencies approach these issues, or especially around governments, their quote unquote sovereign ratings, and especially how they've implicitly or maybe even explicitly been responding to critiques, either from MMT or what, as Scott was talking about, what they imagine MMT's point to be. And if you're on Twitter, whenever these sort of conversations coming around, you can see people, kind of make comments around money, about money creation and about government money creation in response to these ridiculous rating agency pronouncements. But the last year or so, I've kind of been digging into the details of how the rating agencies approach that. I've read all the three major rating agencies, Moody, Fitch, and S&P's rating methodology documents, and it's especially interesting because they've all updated their documents since the pandemic has started. So they've been more responsive than ever to the arguments out there. And when you read these documents, what comes out is they're not doing credit ratings as we sort of think of credit ratings, as we think of, say, is Johnson & Johnson able to pay back its debt? Really what they're doing is macroeconomic rating. They're rating the macroeconomic policies of different countries, how good they are. They're sort of like macroeconomic strength in a vague, wider sense. And this is clear when you read the rating methodology documents, but it's not clear to the public when they get these sanctimonious pronouncements. And there's two issues with that. One is, why do we particularly care about rating agencies' macroeconomic opinions? There's no particular reason to think that they have particular macroeconomic expertise versus the judgment of any other economist, even orthodox economists. The other thing about it is like, well, okay, what do they mean when they're giving a bad rating, or they're warning about fiscal issues, or they are, they do a downgrade? What do actually they mean by this? And I'll get to that in a bit, and it sort of relates fundamentally to Scott's work, some of which he was touching on in his presentation here. In the piece that I wrote about this, I talked a lot about the recent debt ceiling fight and the ways that didn't impact or not impact the recent Moody's downgrade. I'm going to skip over that here. If you're interested in discussion of that, you can read my piece on that. Because I think there's a more fundamental, broader issue here. So what do I mean by, like, it's a macroeconomic rating, not a credit rating, and why, hey, the government can create money is not actually a full response to the claims that they're making. And, to be more particular, what I mean is, and this is, just for my piece, the fact that the US is a currency issuer, that it issues government debt denominated in dollars, in a currency it controls, that it has some relevance. Governments do get different credit rating based on foreign denominated debt or not. This is something that rating agencies have become more aware of and more conscious of the last 15 years, but it's not definitive. They don't just, it'd be the easiest thing in the world in some sense. It's like, oh, does the government, do they issue their debt in their own currency, and do they do that, and do they actually create their own currency? Okay, good, AAA rating, move on to the next one. Takes 15 seconds, I can teach a 12-year-old how to do that and write up like a one-pager on that. But that's not what they're doing. So then there's this question of what they're doing. And before I get to what they're actually doing, they're to kind of like illustrate my point and this angle in which I've like gotten into that there's something weird going on here, is that the sovereign credit ratings apply just as much to central banks as they do to their governments. So you might naively or have an instinct that they must be, basing their arguments about central bank independence. Central banks create the currency, governments don't. The government, can have a bad rating, but the central bank, of course, it's the central bank. It has a good rating. I mean, the Fed is the king of the world. Who could possibly give the Fed a bad rating? That is not where they're going with it. And so to me, it's interesting to quote directly from Fitch's most recent rating methodology documents on this. Central banks, like other public policy institutions, are agents of the sovereign, but as part of the macroeconomic policy framework are considered to be very closely linked to the sovereign. As such, Fitch typically rates central banks at the same level as the sovereign. Similarly, securities issued by a Fitch-rated central bank will be typically rated at the same level of the equivalent securities issued by the sovereign, albeit those liabilities are typically not included in Fitch's calculation of government debt. Of course, that last part doesn't make any sense, but that's a really remarkable thing. Fitch is saying it does not think that a government security is any less creditworthy than a central bank security. So clearly, this is not about some central bank independence argument. And in fact, if you look at their rating methodologies, central bank independence gets you a higher rating than not having an independent central bank, quote unquote, as they judge it. So it's actually the opposite. And this is getting to this idea that it's about macroeconomic policy. Of course, they're adopting orthodox economics so wholesale. So of course, central bank independence is good. The more central independence, the better. Oh, you know, you're running bad macro policy if you're not doing everything that the IMF says. And Moody's has a similar quote. This is universal among all of the rating agencies. Because the central bank's credit profile is typically inextricably intertwined with that of the government, and therefore influenced by the same credit fundamentals, issuer level and instrument level ratings assigned to a central bank typically correspond to those of the central bank. And S&P is the same one. You get the point, so I don't have to read the S&P quote as well. So clearly something else is going on than we think. Then you kind of would react to, you know, a tweet you see about this. If central banks are rated the exact same way, they think that their central bank security has the same default risk as, or quote unquote, has the same default risk as a treasury security. So what is this other thing that's going on? And the key to this other thing that's going on is, and this is where I was talking about it getting to Scott's work, is when you look at it and you get into the details, you get in the weeds, all you're discovering is neoclassical macroeconomics all over again. Really, what all these rating agencies are doing, despite their complexity and sophistication and these 30, 40-page complicated documents, what they are doing is essentially picking up an Olivia Blanchard textbook, reading what it says about fiscal unsustainability and going, this is gospel's truth in the world. And you know, from people who've read Scott's work know very well, the technical definition of fiscal unsustainability is that interest payments are on quote unquote the national debt are growing relative to GDP. And so they're growing, you know, you've all seen those kind of graphs where you get 1,000 trillion billion interest payments over 50 years. It's exactly that. So interest payments now are, let's say, like 3% of GDP. Well, they're going to go to 4 and 5 and 6 and 10 and 40. And by 2060, they're going to be 60% of GDP. And the interest payments are just going to the moon. And that's what fiscal unsustainability is. That's what a fiscal crisis is. And so the argument there is, of course, the typical argument, well, you can't just print money because print money will cause hyperinflation and yada, yada, yada. You know, some of the same things that that Scott was talking about, and all these kind of arguments about monetization. And of course, also, if you read Scott's work, you know that this is missing the point. For MMT, the key part is not this notion of printing money. As Scott was saying, it doesn't matter whether you're issuing government securities or you're issuing settlement balances. What matters is the interest rate that you're setting. It's interest rates that you're setting. And so the question is, why is the central bank setting interest rates in such a way as to you know, quote unquote, cause fiscal unsustainability, as to send interest payments going to the moon? So at this point, this is, we're kind of at the end of the rainbow, have all these other complications, all these documents, but at the end of the road, we're just back to what Scott's work on this has been for 17, 18 years now. making this fundamental point about how neoclassicals define fiscal unsustainability and how it's misleading. And it's just that kind of set of arguments combined with the typical ideas that healthcare spending is going to the moon, and that is, you're going to cause a big deficit. That then leads the interest rates to be higher, and so on and so forth. And and these rating agencies themselves, they don't proffer their own forecast when they want to buttress what they're saying. They just point to the CBO's forecast, and they just point to the CMS's forecast. It's all the same junk at the end, with some interesting, complicated details and obscure terminology that you have to go to the documents and kind of suss out. And this fundamental issue, this idea that what a central bank decides in terms of its interest rate policy is somehow quote unquote fiscal unsustainability, has been MMT's focus for a long time. It's been Scott's focus for a long time, and it's a motivation of a lot of the work that us at Modern Money Network has been doing. I put out a report in January of last year, the new monetary policy that was precisely focused on trying to take interest payments out of the conversation and make it a conversation about resourcing your budget. Where are you going to get the fiscal resources, rather than these sort of fantastical financial ideas. And in that report and the ideas that we're pushing forward, it's the idea that, okay, you're saying you need to respond to the economic situation, you want to manage demand conditions, hell, you even want to use monetary policy. Well, there are alternative non-interest rate tools that you can use, direct credit regulation. And the thing about using direct credit regulation to manage demand is that it's fundamentally, it's not going to increase interest payments in the economy. The ultimate argument is to park interest rates on government at zero or low. What I've used the term ZIRG for, zero interest rates for government. You could then do LIRG, low interest rates for government. But nonetheless, whatever way you want to put it, the ultimate issue is taking away this ridiculous conversation about interest payments going to the moon. And that, despite what all the mainstreamers say, that's not actually about fiscal policy. That's about monetary policy. That's about redesigning our monetary policy for to make it clear to everyone that this issue of government interest payments going to infinity is a ridiculous issue. Now, to be clear, and that's what I'll end on, even if you use kind of normal monetary policy, that still shouldn't happen, because at a certain the incoherence, which is something that James Galbraith has pointed out, Scott as well, that there's a kind of double think going on here where interest rates can manage inflation, but somehow interest payments are also going to explode to the moon. It's like Schrodinger's interest payments. They're so huge that they're going to cause a fiscal crisis, but they also are so insignificant that they don't have any effect on inflation, on overall demand, or any of these things. So you can't do two at once. And in the real world, if we're going to have interest payments that are 60% of GDP, that's a lot of income to the economy. That's a lot of spending. Now we can argue about whether raising interest rates at certain levels decreases demand or not. But regardless of whatever you think of those kinds of arguments, at the point where we're talking about 40% of national income, 60% of national income, clearly the interest payments are the prime factor, and the way you cut the interest payments is cutting interest rates. So this is what I mean by the Schrodinger's interest rate, is that you have to, for this mechanism to truly, you can't have both things. Like, either the Federal Reserve is actually trying to manage inflation, which means at some point it's going to see the better thing to be cutting interest rates, and cutting interest payments to the economy, or it doesn't care at all, and it's just gonna, it's just exploding demand because it's ideologically committed to it. And then the problem is not that where things are fiscally unsustainable, it's that monetary policy is unsustainable. Monetary policy needs to become sustainable by lowering interest rates and becoming inconsistent with the state of the economy. The final thing there, of course, is that you start thinking in this way, where you're not just thinking the Federal Reserve or the central bank with interest rate policy can always manage everything. Then you need a budgetary policy that is, as Eric was talking about, in functional finance terms. You need to actually be budgeting demand, not budgeting. You need budgeting demand, not budgeting quote unquote revenue or dollars. And the thing that opens up when you start budgeting in demand terms is that there's all these things that don't collect any revenue, but can reduce demand in the economy. And this is why I've coined the term non-fiscal pay for. So there's all these non-fiscal pay fors that can reduce demand. The key one, going back to what I was talking about earlier, is direct credit regulation. And I think COVID itself, I'll end on this point, COVID itself, not in an ideal way, but just as like on the intellectual level, in a conceptual way, illustrates the power of non-fiscal pay fors. Because what happened with COVID is we shut things down. Safety and health regulations were contractionary. They drained demand out of the economy. As long as we were imposing strict health and safety regulations, and the world's economy essentially shut down, and then fiscal policy needed to step in. Now, in that way, it's sort of the reverse. Rather than you having a non-fiscal pay for fiscal policy, you need fiscal policy to provide the demand compensating for all this non-financial regulatory contractionary policy that you're doing. And so, obviously, if we're thinking about non-financial regulation in demand terms, we would not do something like 2020 health and safety regulations, but nonetheless, in the context of climate change, thinking about how contractionary environmental regulations can reduce demand and can be a part of a package of quote unquote pay fors, demand offsets, whatever you want to say, for whatever kind of fiscal program you're launching, it is a really, really important example of how these things can actually be a really big deal. Anyway, and that I'll end.
We'll take some questions before that. So let's take 3 or 4, and then we can let our panelists answer, and then we'll take another one. Yes, Daniela.
Thank you. I have a couple of questions for Scott. Perhaps I misunderstood some of the remarks you made. First, can you please clarify what you think is the link between liquidity? You talked about liquidity and market liquidity of government bonds. You showed that picture with the Federal Reserve giving loans to primary dealers, and you said that, and I can't remember exactly the quote, but you said something to the effect that if the market is liquid, then credit creation happens, or something along these lines. And that's a strange kind of causal mechanism to my head, but I'm curious to understand or for you to clarify what you meant. And the second one is, I know where I am, so hoping not to pick a fight with the guy I am. To make it a bit more exciting. So I think one of the criticisms that have been directed towards MMT is the absence of a strong theory or a strong political economy conversation or debate. And in one of your slides, you said the central bank has no interest in market discipline in government, in its own currency, and no reason why deficit should correct government bonds for liquidity. I mean, every central bank I can think of has an explicit political interest in the market discipline governments. So I'm curious, can you reflect a bit on what is the political, why is this statement so clear? It's outlining any political economy of monetary dominance in which we live. The developments over the last 3 years, the fall of the Liz Truss government in the UK, and I can go on and on.
Sure.
Yes.
Yeah, I have a question, or rather a suggestion for Eric regarding your index of monetary sovereignty. You know, and you pointed out in the beginning that maybe a very initial form would be a dummy of just 0 and 1. Maybe try that. The second would be to to look at what the investors' perceptions of monetary sovereignty, do a survey, depending on list of countries and what they think is 0, 1, a giant, because some countries may have a fixed exchange rate regime, etc., etc. But any work that you do on this would be very interesting.
I just had a comment on and I think the conclusion is correct. When the credit raters downgraded Japan, I don't remember what year that was, 25 years ago. I wrote to all 3 of them, and only S&P responded with a letter. So they just kind of typed this up, 2 lines. And they said, because I said, why are you downgrading? Do you really think they're going to default on their debt? So, we do not assess the risk of default. We are providing a country rating. And of course, whenever anyone sees a downgrade, they all think, oh, they think the country's going to default, the government is going to default on debt. But they
let's give some responses, maybe
Okay.
not too long, so we can take another round of questions.
Okay. So on the credit, endogenous credit, et cetera, does it help if I use the word funding liquidity instead of
Yeah,
credit?
but it's a very different argument.
Kind of.
Okay. Well, different from the one you.
It was more a use of terms, so I didn't have to define funding liquidity in the middle of everything. If that makes sense. Let's see. The other question, the central bank not have, I would say that the way the central banks intervened in market functioning operations suggests that they don't really want there to be market discipline, even if they say they do.
Yeah. The way I would say it is that they want the form of appearance of
Yeah.
market discipline, but they don't want the reality.
Right.
I mean, this is definitely my experience in doing the research for the book, is there's a kind of attempt to reestablish the idea of a quote unquote free market in government bonds in the 1950s. We're going back away from the bad old Fed Treasury Accord days. But at the same time as they want that ideology of like a quote unquote free market in government bonds and all of the rest that entails, they are doing, as Lebanon's a recent paper with I'm drawing a blank, but the New York Fed guy.
Younger.
Yeah, what?
Younger.
Younger, yeah, Josh Younger. It's right. I don't know how did I blank his name. Anyway, with Josh Younger's paper, that is, that they are telling the technical dealer part of that story, where at the same time as they want the rhetoric of free market government bonds and all that entails, they're building the machinery to make sure that liquidity is always present in the government securities market. That I think Scott is not. I think the Eurozone is a gigantic, exceptional, thing where I don't think that Scott is meant to apply that to the Eurozone. But I mean, I think in terms of governments that have some similarity to the US, which of course we'll get into, but you understand the 12, 14 countries that maybe I'm referring to there, they want the appearance for political reasons, but they don't want the reality.
I would say the ECB's actions in March 2020 suggests that they didn't really want what happened in the early 2010s to happen.
Yeah, but that's a bigger question.
But people have made an argument about the UK, is that what
Yeah.
you're referring to? So, the prime minister proposes a plan and interest rates go up, and then central bank does nothing and the prime minister is ousted. So some people have used that to say that, see, MMT doesn't work.
What I'm saying is, to the point that it affects the transmission of monetary policy in a way the central bank doesn't want it to be transmitted, or to the point that it threatens financial stability. Okay, so for instance, the Fed wants interest rates to go up right now, right? I think the Fed would love it if the 10-year went up to 6 or 7%, right? So I'm not suggesting they don't want interest rates to rise. I just think it's inconsistent with their own policy goals. They will jump in.
Yeah, I mean, and on the UK situation, I think the UK situation, of course, this is very debatable. We'd have to get into it more, but I think that is a key case in point where they're saying we're intervening with this time limited period, creating stability, but like not beyond this point is creating a situation where they want the appearance of market discipline to crush the government and to crush trust as government, but they don't want the actuality. Like the Bank of England doesn't want the UK government securities market to actually fall apart. They wanted contained instability that could accomplish the political outcome that they wanted, and they wanted the cover of market discipline for what they themselves were actually doing. So that's where I would say it's like that's what I mean by the form of appearance, the ideology versus the reality. So I don't, when Scott says that, you know, they don't want market discipline, I don't think he's not saying they don't want a form of appearance of it. They don't want the ideology of it out there. It's about like, they don't actually want these gears to fall apart.
No.
I have a point of clarification, so to do with this conversation about market discipline. So I'm a little bit confused. Is an interest rate hike not market disciplining? I mean, there's the liquidity issue.
No, it's not. No, it's the central bank just trying to set the interest rate where it thinks will balance the economy.
So the current push, like if the, as you said, Scott, that the Fed would like us to go up to 6 to 7,
Right.
that wouldn't, in your view, be a form of disciplining the market?
Meaning
necessarily.
disciplining the treasury
Right,
to
if it
try
went to 20,
spend
yeah.
less, right?
But
Yeah.
Sorry, so you have like an arbitrary own definition of market
Yeah.
discipline that doesn't reflect.
No, I mean, the 20 is a too casual mark. What I would say is that so this is a difference between quantity accommodation and price.
Right.
They're not going to give the government whatever price that they want, but they don't want to get to a situation where if the government wants to have an auction, that like auctions permanently fail. If they want, you know, as he said, funding liquidity. It's about quantity accommodation. They never want to get to the point that you know, just use the US example. Congress passes an appropriations bill, you know, debt ceiling aside, you then, you know, issue securities and you spend. They don't want to get into a situation where that mechanism falls apart. Now, do they perhaps want higher interest rates to then make people go, oh, look, interest payments are so high, so we can't spend, so we shouldn't spend? Yeah, sure. They want that political impact. Volcker, of course, wanted that political impact, but he didn't want the mechanism to break down where literally it would be operationally impossible for them to issue securities and fund spending that and spend to have the treasury to spend where congressional appropriations, that they didn't want that. I mean, I think that's clear when you look at any of the internal Fed documents about this.
And in
If you-
2019,
yeah.
right, we had that experience in September of 2019 when that was about to happen and the Fed very quickly intervened and brought interest rates down because at that time they wanted interest rates.
Yeah, I'm gonna say, so next week, I'm just giving a concrete example of this. You know, I wrote an op-ed earlier this year in Politico about this 2011 memo, where what is the Fed gonna do in case there's a default because of the debt ceiling? And I've gotten the memo with FOIA, so I'm publishing a piece about that memo Tuesday. And that in that document, it's all about that they're intervening for financial stability purposes, and what they're willing to do is absolutely extraordinary. They are going to buy the defaulted treasury securities. They are going to accept them for the same collateral price as undefaulted securities. They're going to the hilt, backstopping in every possible way, every possible mechanism, you know, doing what they need to do to step in on the repo market and reverse repo. And they're doing it specifically because of their financial stability mandate. So, you know, they're willing to step into when securities defaulted to sustain liquidity. They don't want this machinery to break down.
Yeah, to add more context to that, if you go back to the treasury auction mechanism, they were actually developed quite late. And until the 1970s, a lot of them were undersubscribed. So you didn't have enough buyers for the security. So what would happen is the sort of would step in and just buy the rest of them. So yeah, we do want this pretend of market discipline, but we never get to the point where we prevent the Treasury to find the fund it needs to implement the congressional budget.
Oh, yeah, so just a couple quick questions. So Singapore seemed to have an interesting model there. Just, I wonder if you could elaborate how they could do what they do. And also for Nathan, do you think these credit agencies could have any positive role? I mean, I know that MMT, sorry, people on Twitter were, upset about the ratings downgrade that seemed to follow the debt ceiling fiasco. Do you think, would they have any rating, role at all in reflecting on, well, this is what markets think about the playing around with the debt ceiling that happened, or it seems to be might be a legitimate function of those ratings, to comment on that, even though there are these mechanisms, as you say, that would, backstop the security, so, yeah.
Scott.
Wait, Nathan, let's take
Oh, so
one
take
more
one.
if there are any more questions.
This is just a clarifying question, Scott. I got it from your presentation, but I think any of the presenters could probably answer this. In your response to Jason Furman, when it was like, the long-term deficit has to be like 3% of GDP or whatever, and you're like, well, with reference to the current account deficit, if the current account deficit is higher, what's that doing to the health of private balance sheets? In a world where the health of private balance sheets, are non-governmental balance sheets, say domestic non-governmental balance sheets, are a policy goal of ours. Is the current account deficit the best statistical measure of the external deficit that we should be using? Is there a different measure? I go around saying the current account deficit as well, but I don't know if I should be using like a different statistical measure or not. So the constant question I have is when I tweet about this, the CAD is what I usually reference, but I don't know if you all have opinions on maybe there's a different measure, either one that exists or ought to be constructed if we had, the means to.
Lauren, yeah, so I guess just briefly, talking about monetizing the debt and so kind of Scott and Nathan talks, I'm curious as well, just for the general MMT community, like if there's a preference between speaking about the debt and kind of helping everyone get over the fact that what we call the debt, what it is and what it's really just about deficit spending, right? And so is there a preference in the MMT community between just stop issuing bonds and get rid of the national debt and get rid of the interest on the debt versus, having everyone kind of understand what it is and that there isn't a huge difference between monetizing the debt versus issuing treasury bonds? Notwithstanding the fact that maybe you want to do synthetic securities from the Fed or something, but like, do you have a preference in MMT between just like stop issuing bonds and get rid of the national debt and the interest on the debt, stop having this crazy debate, or have people understand it in that way? Is there another one, maybe the last one we can take?
Sort of throwback to the last panel, I'm wondering what about your presentations changes when you're contemplating the developing context where private sector liquidity for the bond market might be very limited, and the central bank might not have a lot of control over interest rates.
And if I may add one, Eric, that's for you. So let's say you do construct your index, then how do you operationalize it in terms of policy, right? So how does it help? Like, can you spend so much if the index is X and you can spend that much if the index is Y? Whoever wants to start, Scott, maybe you go ahead.
A lot. I guess I'll take Michael's question first. I think in practice, like, they're just useless. I mean, the fact that they let this misperception of what their ratings are about, like that they call them credit ratings rather than macroeconomic ratings, like they are just interested in obscuring what's going on, and I've seen no sign that they want to at least clarify what their perspective is to the public. And I also think in practice, governments do what they want to do, regardless of the rating agencies, as long as the rating agencies don't actually impact the functioning of their mechanisms, and they don't, as we've seen with the rating downgrades of the US. I mean, you know, not to put too fine a point on it, but there's discussion about a downgrading of Israel right now in response to an extended war. I don't think anyone realistically believes that the threat of a downgrade or an actual downgrade is going to stop what Israel wants to do. And I think it's all it does is, you know, what it's agnotology. It's the intentional production of doubt, and they're without really fundamental transformation. I think that they're just useless, and there's no possibility of hoping that we'll get the policies they want with, you know, constraining militarism or anything like that from the rating agencies.
If I can add something, it's actually misleading, and it's also incoherent. One of the elements they use to grade is inflation risk. Okay, and so the idea is that if you have more inflation, you should get a downgrade. But at the same time, they also want to grade some form of default. And so if you have one of the source of statistic they look at, and is the amount of tax revenue you get. And so the more tax revenue that increase your rating. Well, higher inflation increases the amount of tax revenue, which increase your rating. But at the same time, you're telling us that it's decreasing it too. So that with this mismatch of things creating coherence, basically.
On the sector balances one, I tend to teach that as sort of a 20,000 foot view. That's how I go about it. So in the sense of private sector surplus is falling, going negative, et cetera, that sets off alarm bells, but that doesn't mean necessarily something. I mean, historically, it's been a really good proxy, right? But I treat it like, for a business, a statement of cash flows. Like when I go look at a business, the first thing I look at is a statement of cash flows. That'll tell me some things that are going on, and give me, you know, something's potentially wrong where to look, right? But it's not the end of the story. So in terms of is the current account or whatever, right? I kind of go about it differently. So when I was doing the Indonesia project, they had a pretty persistent 0 or negative private sector balance. It was because of the non-financial business sector. It turned out it was because of issuing equity, right? Not issuing debt, more than anything. Now, it did have a financial stability issue, which was most of that funding was coming from abroad. And so when COVID hit, you saw it leave, right? But so that's kind of what I mean. I don't know if I answered your question, but I would go about it a little bit differently than what you said, but that was a good question.
So also, do you use net exports or current account balance? Really doesn't matter, because if you do the accounting right, the only thing you do is current account balance. You just add foreign transaction income in there, and you have to account for that. Both it's coming in from somewhere and going somewhere. So you get back on your feet in terms of the sector or balance identity, whichever way you do it. I think it doesn't.
Although I would say on the well, it's more of an exchange rate and such issue, but I think the literature on gross flows has pretty much illustrated that if you're looking at the macro situation, the gross flows are a better indicator. Okay, so there was a question on Singapore. How do they do it? Or
It just seemed like an interesting,
yeah, well, I mean, how do they do it? Nobody thinks they're doing it. That's part of it, right? Yeah, I think it's brilliant, honestly. It's brilliant. Yeah, it's absolutely brilliant. Everybody thinks they're the you know, one of the most fiscally responsible nations there is, and they're, you know, printing money like drunken sailors. I'm exaggerating, but so just so you know, I'm exaggerating. But yeah, I think it would be really interesting to see, because what they're basically saying is we aren't a government, we're a bank, right? That we are taking in liabilities, purchasing assets, and the cash flow that we get is more on the assets than what we pay on the liabilities. And so I think it's brilliant.
If you can say a few quick words about the last two questions, so debt versus monetization, Lauren's question, and then the developing country context. Yeah.
I'll take Marin's question. I mean, I think my position is, I'll just say my position first and then talk about the broader thing. Clearly, Rowan and I have been pushing very hard on explicit, overt, it's the best term to use, Stephanie's term, overt monetary finance from the Treasury, whether it's the $1 trillion coin in the US context, whether it is some sort of e-cash, digital currency instrument, whatever it is, you know, go back to the good old greenback. You know, we're pushing very hard on thinking that like this clarifies things very hard to have Treasury explicitly money financing things. You know, the corollary is the work that I've been doing on central bank securities and the Federal Reserve just issuing securities on its own. After doing some work on it, realized that this forgotten, but at the time important economist from the 40s and 50s, Albert Hart, had that exact proposal. And so yeah, I think, you know, that's pretty open about having that kind of position. There is a little bit of a complication, as we've seen with the platinum coin and the debt ceiling issues of when you have a system that purely relies on the Fed as a fiscal agent, and these legal questions come up about the Federal Reserve fulfilling its responsibilities as a fiscal agent, and these very extreme, extraordinary comments that the Fed will abrogate its responsibilities as a fiscal agent because it, you know, feels icky or whatever. And that, you know, that brings up the issue of wanting kind of alternative tools outside of purely relying on the Fed as a fiscal agent. You know, it's a banker, financial related services, which the Fed does it all. The Fed runs the Treasury securities. The Fed runs, you know, payments with its payment system. I mean, you know, the only meaning in which the Treasury securities are Treasury securities is that they are like legally an obligation of the Treasury. Functionally speaking, they are run by the Fed, and they've been ever since Treasury securities were digitized and put into a book entry system over the course of the 70s. So there's a complicated question about that, of like wanting to keep sort of alternative powers that don't rely on the Fed as a fiscal agent. But of course, Treasury securities are not one of those things. They're already dependent on the Fed for that. So on the broader thing, I don't think, you know, I'm not going to represent that there's a consensus on, you know, Rowan and I's position here. I think it's still a subject of ongoing discussion. I think people see the point that we want, that we're making there. I think people also see the purpose of see a reason of wanting, just for, you know, public clarity, not having any form of security issuance out there at all, and just do everything through overt monetary finance. I think it's an ongoing discussion between us.
Can I just make a quick addendum to that? One of the differences also is just legally you can do things with securities that you can't do with a reserve account or with a term deposit account. And whether you think those are important social things or not, or that like fighting that fight a day after we win the fiscal clarity fight is a different thing. But like a security is just a different legal structure than the deposit account.
Yeah, I don't.
Yeah, rehypothecation, collateralization, bearing instrument, ownership rules rather than identity-based account rules, things like that.
I mean, it's difficult because this is one case where you have the economics profession just wrong, and they have basically been very successful at creating that narrative that monetization is bad, hyperinflationary, blah, blah, blah. My guess is probably half the room still thinks that it is. So my focus is on the economists for now, because I don't know how you tell a complicated story like this to lay audiences, honestly. So I'm not the one to try to do it, but I think going to the developing country one, which is a really good question too. It's again, the economists, right? I mean, if a country said, well, let's just build a liquid market, and blah, 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 that might help. Liquid markets don't just grow up overnight, right? So, and so then the overt monetary financing, or whatever we're calling it, IMF's not gonna like that, right? And so, yeah, it's difficult. And so I think it's a multi-pronged attack, where a lot of the stuff that was talked about in the previous panel is part of where you go with it.
And part of it is also intellectual capture. So if you read, for example, as I mentioned again, the Manon and Younger paper, in the Western context, in the US context, there is an explicit and conscious project of building liquidity in the treasury market as this technical operational thing that no one really pays attention to, and like maybe 14 people in the world know the details of that history under the William Mackenzie Martin Fed. And so when economists come in the 80s, 90s, up to today, into another country and start giving advice on the treasury market and on building, they just have a textbook understanding rather than the reality of what happened in the West. And so they're not going in for first of like, okay, you need to set up a primary dealer system, and you need the central bank to license primary dealers, and all of that sort of mechanism design things. They're not thinking in terms of, with some exceptions, like someone like Peter Stella, former IMF, I bet he is more telling people like that. But it's basically like a luck of the draw. Do you get Peter Stella, or do you get someone who's just completely clueless? And Peter Stella can't be everywhere at once all the time. So that's the fundamental problem. Is you have people who have the textbook understanding and don't know how it actually was built, and so they try to build the textbooks, doesn't work, and then they go, see, this is all the problems with these dysfunctional governments, when it's really dysfunctional Western ideology.
All right. Thanks to our panel. We'll wrap it up here, but there's the coffee break, so you can continue the discussions then, and let's reconvene at 3:45
Yes.
for the next.